Earnings season is getting underway, and for me, it's an exciting time of the year. Companies report their financial statements that reveal their performance on revenue and profits. And this is really what I focus on when making investment decisions. Management teams also reveal any major strategic changes or investments that could impact investors meaningfully. This earnings season, there are a number of major themes sweeping across the stock market. In this video, I'm going to discuss 5 major factors to keep an eye out on and a few examples of stocks that are benefiting or hurting from that particular trend. So let's begin. The first trend that I'm really focused on this earnings season is the away from home trend. Of course, during the pandemic, we spent what seemed like an eternity at home. And so we were missing out on things like going to theme parks, traveling, just going out for a cup of coffee with friends. All of those things are now recovering, and these 3 companies, the Walt Disney Company, Airbnb, and Starbucks, are all poised to benefit from that trend. Let me show you an example here of what's going on at the Walt Disney Company. So what I have pulled up here is the Walt Disney Company's most latest results on as of December 31st, 2022. You can see the theme park revenue here domestically. Theme park revenue jumped 27% year over year, as well as international revenue at theme parks 27% jump. The operating income in these areas also jumped. The domestic theme parks operating profitability jumped by 36%. Internationally, it jumped by over 100%. Now, the companies, as you are noticing here, is benefiting not just on an increase in sales, but also an even bigger increase in profitability because Disney, in particular, instituted price changes, increases, and cost efficiencies, which is allowing Disney to increase its profitability. I'm looking for this trend to continue, and I'm looking for Disney's management to give me some forward guidance on how long they think these good times will roll, because boy, are the good times rolling for Disney's theme park segment, as you can see here. Additionally, Airbnb is benefiting from this trend. Look at Airbnb's revenue I have pulled up here in its most recent quarter. Revenue jumped from 1.5 billion in the same quarter last year up to 1.9 billion. Income from operations, that jumped from just 76 million in the same quarter last year to 235 million in the same quarter ending in December 31st, 2022. With Airbnb, I also expect this trend to continue and persist as people are unleashing this pent up demand for away from home experiences. One last company I will give an example of, and one that investors can look out for this earnings season, is Starbucks. Of course, Starbucks had to close many of its stores temporarily, and Starbucks suffered as people were spending more time at home, less time at work and at school, allowing for less occasions where you might drive by or walk by a Starbucks and drop in to pick up a cup of coffee. So North America sales, I've highlighted here, jumped by 10% in its most recent quarter. However, sales in China decreased by 29% in its most recent quarter. Remember, the Chinese economy is only recently started to reopen, so Starbucks is really going to catch a tailwind from economic reopening this quarter, because at the end of the first quarter, the US and China comprised of 61% of the company's overall global portfolio, with 15,900 stores in the US and 6,090 stores in China. So the Chinese economy is a major contributor for Starbucks, and that's only begun reopening. In this upcoming earnings report, we will hear from Starbucks and how much it's benefiting from the reopening of the Chinese economy. Regardless, these 3 companies are benefiting strongly from this away from home trend, this unleashing of consumer demand for away from home experiences, and this is where I am positioning myself to benefit as well. I own all three of these stocks: the Walt Disney Company, Airbnb, and Starbucks. The next trend to look out for this earnings season is cost cutting. Cost cutting. During the earlier stages of the pandemic, companies like Meta Platforms, Alphabet, and Amazon were absolutely thriving as people were spending more time at home, buying more stuff online, logging into their social media apps more often. And this was all very good news for Meta Platforms, Alphabet, and Amazon. All three of these companies hired aggressively during the last 2 years and really added onto their cost structure. Now that economies are reopening, these three companies have announced major cost cuts and admitted that they overinvested during the earlier stages of the pandemic, thinking this robust growth may last longer than they thought. So now, and I'm sure you've heard in the news, Meta Platforms, Alphabet, and Amazon have all undertaken cost cutting campaigns. That said, I think it hasn't gone far enough. I think they need to undertake further cost cuts to get their profitability back in line because revenue growth has significantly slowed down for each of these three companies, and for that matter, others that were also beneficiaries of that stay at home trend. I'm just going to show you one example out of these three in the cost cutting trend and the necessity of that trend. What I have here is Amazon's latest information as of December 31st. On the left hand side, we have the quarter ended December 31st. On the right hand side, we have the year ended December 31st. And what you see here is net sales jumping in the most recent quarter from 137 billion to 149 billion. However, operating profit falling from 3.46 billion to 2.7 billion. So despite Amazon's revenue jumping by nearly 12 billion in its most recent quarter, its operating profits fell by 700 million. If you look at the year in 2022, it looked even worse for Amazon. Net sales jumped from 469 billion to 513 billion, but operating income fell by more than half from 24.9 billion to 12.2 billion. So despite sales jumping by $44 billion in 2022, Amazon's operating income fell by $12 billion. This is evidence that the company overinvested during the earlier stages of the pandemic, and it needs to moderate those. It needs to lay more people off. It announced some cost cuts, but I think they need to go further, and we're going to know more about that when they announce their earnings in this earnings season. That's what I'm looking out for. I'm looking out for how much operating income has fallen this first quarter from compared to the year before, and I'm looking for any guidance from management talking about further cost cuts, more efficiencies, and more work that's done to improve profitability, because this is not what investors of Amazon stock want to see. The next major trend to look out for is interest income. Interest income. This might be something that you have not been paying attention to, but you have been hearing about rising interest rates on the other side of valuation, right? You've been hearing about how so many growth stocks have seen their stock prices fall as a result of higher interest rates, right? Because that decreases the valuation, because that decreases the present value of future cash flows, and thereby decreases the amount investors are willing to pay for growth stocks. But the flip side of the equation is now going to come to fruition in this upcoming quarter. And that is that higher interest rates are going to allow companies with cash balances to generate more income on that interest. Just like you and me can take our money and put it into these interest accounts now that give us 4 or 5% interest on our savings, companies can do the same thing. Companies can do the same thing, and they stand to benefit significantly from this trend. So I'm going to show you two examples, and three companies are going to benefit. Palantir Technologies, Airbnb, and Alphabet will surely benefit from this trend. I'm going to show you two out of those three specifically in how much they can benefit. So I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So what I have here is Palantir's latest quarterly financial statement, and I want to draw your attention to this line here, interest income. And you notice already a big jump here year over year, as Palantir's interest income jumped to 12.7 million in its most recent quarter. That was up from just 480,000 in the same quarter the year before. If you look over the year in 2022, 20.3 million in interest income compared to just 1.6 million in the same quarter the year before. Now, the reason I picked out Palantir and Airbnb specifically is because not just that they're going to earn interest income, but because of the proportion of the interest income to their overall operating income. So let's take a look at that. If you look at Palantir's overall income from operations, loss from operations, they lost 17.8 million in income from operations in its most recent quarter. Well, they made up some of that with only interest income, 12.75 million. So the income from interest almost turned Palantir positive in terms of the bottom line, because of that increase. Now, they were positive on the bottom line, but it wasn't because of interest. It was because of this other income line item that boosted it over to positive territory. That said, in this upcoming quarter, Palantir could generate even more interest income. Let me show you why. So here I have Palantir's balance sheet, and if you look at its cash, it has $2.6 billion of cash as of December 31st. 2.6 billion. Now, depending on which short-term interest rates you look at, Palantir could get between 4 and 5% interest income on this cash on very, very safe investments. So let's just say it only gets the lower end of that at 4%. Well, at 4%, that could mean annualized, this would be 40 million at 1 billion, and then another 40 million at 2 billion. So that's 80 million. And then at the 600, we do another 24 million. So that would get you to $104 million annualized interest income for Palantir. So if we divide that by 12, putting it on a monthly, let's just make it rough estimates, 10 million per month. And so for the quarter, Palantir could report interest income upwards of roughly around $30 million. Of course, depending on which specific short-term investments it chooses to allocate this cash to, and if it chooses to allocate it to these short-term investments. So this figure of interest income of 12.75 million could jump as much as 30 to 40 million in Palantir's upcoming quarter, and I'm going to be looking for that figure when Palantir reports its earnings results in this earnings season. And that is similar with Airbnb. I'll show you Airbnb's interest income of 103 million in its most recent quarter. That was up from just 4 million in the quarter the year before. And it, compared to its income from operations, it was almost 50%, right? Airbnb in its most recent quarter generated 235 million of operating income, and then it added 103 million from interest income. this could also be boosted in its upcoming quarter because Airbnb, like Palantir, has a huge cash balance sitting in its balance sheet. Look at it has 7.378 billion in cash and equivalents and another 2.2 billion in marketable securities. So Airbnb has about 9.6 billion dollars in cash and equivalents, nearly 5 times what Palantir has on its balance sheet. So again, it could deliver an increase in its interest income higher than what it already was, which was already significant. So that's a tailwind that investors can look out for from these growth stocks that have suffered from the downside of higher interest rates. Now at least they're getting some of the upside of higher interest rates. The next trend I want to look at is a headwind, something that companies are experiencing declining revenue and profits from, and that's the decrease in spending on long lasting goods. Decrease in spending on long lasting goods. And this is because spending in these categories jumped during the earlier stages of the pandemic, right? In 2020 and 2021, purchases of long lasting goods exploded. That's because we were spending more time at home. Our bank accounts were boosted with stimulus money. And so what did we do? We spent a lot of it on things like flat screen TVs, laptop computers, desktop computers, iPads, furniture, refrigerators, laundry machines, things like that. We spent a lot of money on during the earlier stages of the pandemic in 2020 and 2021. And these things last a long time. So once you buy it, you don't need to buy it again for 4, 5, 6, 7 years. And so that pulled forward a lot of demand for these items. And so now there's going to be this gap between when people are buying these things again. And that's bad news for several companies that sell those types of things. And I've highlighted Nvidia, Intel, and AMD. And there's more, but I've just picked these three out just to highlight this trend. Now I'll show you sales year over year for AMD, Intel, and Nvidia all decrease in their most recent quarters. Nvidia sales dropped by 26.99% compared to the same quarter the year prior. AMD was 14.5%, and Intel was 8.35% percentage change from revenue from the quarter before. Now, I suspect this trend to continue. In fact, there was a report out in the Wall Street Journal that said that worldwide personal computer shipments decreased by 30% year over year in the first quarter. 30% decrease year over year in the first quarter. Now, Nvidia, Intel, and AMD all sell their products to end users that are computer buyers, right? So Nvidia's graphic processing chips, Intel's computer processing units, AMD has both GPUs and CPUs. They all are inputs into computers, and those purchases are falling considerably, and that's likely to persist for at least the rest of this year and going forward. So this is what I'm going to be looking out for when these companies report their earnings. I want to hear some insight from management on discussion of when they expect this to bottom out and turn around and improve. So that's something I'm looking out for. And that's an area I don't want to be investing in. So I'm not invested in any of these three companies. I don't own any of these three stocks. And another trend to look out for is decreasing enterprise spending. So as you're noticing the impact from rising interest rates from the Federal Reserve has caused a slowdown in economic activity. Worldwide gross domestic product is falling, or at least the rate of growth is falling, and that's causing enterprises to fear a recession, so they're pulling back their spending. So if an enterprise is thinking about, hey, let me invest in shifting my IT from on premises to the cloud. I want to make that investment. I want to make that switch. What they're saying now is, okay, yeah, we want to do that, but let's not do that just yet. Let's wait to see how deep this economic slowdown is going to be. So let's maybe pause that project. Or let's say for the case of Palantir. Palantir. So Palantir has two business segments, right? One that serves government institutions, and one that serves commercial institutions. And what you noticed in Palantir's most recent investor report, in its most recent 10K, is Palantir showed that spending from commercial enterprises was pulling back considerably, while its business towards governments was still okay, still doing well. Commercial business spending with Palantir declined. The contracts, the signings declined. And that's understandable, right? Palantir Technologies might offer companies a strong return on investment, right? They might say, okay, I agree, I'm going to spend this money with you, Palantir, but just not yet. I'm going to wait. Give me one more quarter or two more quarters. Let me see how this economic slowdown is going to impact my business before I allocate this major spending with you. So I've highlighted Amazon, Palantir, and Microsoft as suffering from this trend. And I'm looking out for these three companies to also inform us where they see this going. Do they see this bottoming out and turning around anytime soon? Or is this getting worse? Is this trend getting worse? So those are the five key trends I'm looking out for in this upcoming earnings season. And those were a few companies that I'm looking out for as types of companies that will tell me what's going on with this particular trend industry wide, right? So let's review those. Away from home trend, the Walt Disney Company, Airbnb, and Starbucks are benefiting from this strong tailwinds from this away from home trend, and I'm investing in this because of the way I'm seeing consumers really allocate their budgets towards that area away from other areas. Cost cutting. I want to see more of this. Meta platforms, Alphabet, Amazon, they've already started. I want to see more cost cuts. I want to see their operating expenses line up more accordingly with their revenue. Interest income. Finally, growth stocks get to benefit from the side effects of rising interest rates. They've already suffered from declining valuations as a result of rising interest rates. Now they get to benefit from that trend. I'm looking to Palantir, Airbnb, and Alphabet to capitalize on that. I'm looking for higher interest income from all three of them. Long lasting goods. So I'm looking for Nvidia, Intel, and AMD to report on how steep this decline is, right? So are they able to replace the gap of the buyers that are replacing and upgrading existing products with new customers? Can they fill the gap of people that are not going to update their products for another 4 years? Can they fill that with new customers? Can they find enough new customers to kind of fill that gap between the time when those sales they made in 2020 and 2021 need to upgrade? So I'm looking for that. And finally, decreasing enterprise spending. I'm looking to see how fearful, how cautious enterprises are with respect to the potential economic recession. I want to see how businesses are responding to the potential of an economic recession. If we see continued decrease from the enterprise sector or the decrease worsening, that could signal that the probability of recession has actually increased, because it's sort of a self-fulfilling prophecy, right? If businesses fear there's going to be a recession and they pull back spending, well, that pullback in spending is what will actually cause the recession. So that's an important metric that I'm going to be looking out for, and you should be looking out for as well. Okay, so that's all I've got for this video. Thank you so much for watching. This earnings season is certainly going to be an exciting one. I'm going to be covering over 100 companies, completing earnings reviews and updating you on what's going on with them. So if you're looking for earnings updates and progress with these companies, all of these companies I mentioned here, I will be covering their earnings reports. So subscribe and turn on your notifications. This earnings season is going to be a busy one, and I'm ready to fulfill that need. All right, I'm looking forward to seeing you guys. I'll see you then.